If you ask most people what they're worried about financially over the next few years, the answers are almost always the same: a recession, a market crash, layoffs, or some major economic downturn. We've been taught that the economy moves in cycles. It goes down, it comes back up. And if you're patient enough, disciplined enough, and you do the right things, everything eventually recovers. But there's a fundamental problem with the way we're framing the question. Most personal financial plans don't fail because markets are volatile. They fail because they're built for a world that no longer exists. A world where inflation stayed low, money reliably held its value. Over time, bonds were a safe haven, and the US dollar served as a stable measuring stick for everything. In that world, the strategy was straightforward: save consistently, invest long-term, diversify, and let time do the heavy lifting. The previous generation followed that playbook, and for decades, it worked remarkably well. For nearly 40 years, this approach delivered exactly what it promised. The problem is this: a strategy is only as good as the map it's based on. A recession, as painful as it can be, is still just a reset within a stable system. Demand falls, companies cut back, markets correct, central banks intervene, and eventually the economy recovers. We've seen this pattern over and over again. What's happening now is different. This isn't just another bad cycle. It's a shift at a deeper level, the level of the rules that govern the system itself. And when those rules change, the assumptions underneath your financial plan become dangerous, even if the numbers on your account statement still look perfectly fine. This is why so many people today feel a quiet but persistent discomfort. They earn more than the generation before them. They save more. They invest more systematically. And yet they feel less secure. Not because they're doing something wrong, but because they're using an old map to navigate a new terrain. In this video, we're not going to talk about what to buy, what to sell, or where the market might go next. The more important question is this: which system-level rules have changed, and why do those changes turn once safe financial plans into hidden risks? Because the real danger isn't losing money in a bad year. The real danger is spending your entire life optimizing a strategy that was designed for a game, whose rules quietly changed while you weren't looking. For a long time, money played a very specific role in people's lives. It was a measuring stick, a relatively stable one. You could earn it, save it, invest it, and reasonably expect that its purchasing power would hold over time. Inflation existed, but it stayed low, usually around 2 to 3%. Bonds were considered safe. Holding cash or government debt wasn't exciting, but it protected what you'd already built. That framework wasn't naive. It worked for decades. But that rule only held under one condition: money had to be treated primarily as a store of value, not as a tool for emergency system management. That condition quietly broke after 2008. When the global financial system nearly collapsed, money stopped being neutral. It became an instrument. Central banks didn't just adjust rates at the margins, they created money at scale to stabilize banks' fund deficits and prevent social and political breakdown. Since then, every major crisis has reinforced the same behavior. When pressure builds, money gets created, not as an accident, but as a deliberate response. This is the part most people miss. Inflation today is not simply the result of bad luck, supply shocks, or temporary mismanagement. It's the predictable outcome of a system that can no longer resolve its debt through growth or taxation alone. Once government debt crosses a certain threshold, the options narrow dramatically. You can't grow your way out fast enough. You can't raise taxes enough without destabilizing society. And outright default destroys trust overnight. That leaves one path that history has repeated over and over again: reduce the real value of debt through inflation. This isn't theory, it's pattern recognition. In the United States, public debt has moved beyond 120% of GDP. Interest expense is now on track to exceed national defense spending. That means a growing share of new borrowing exists just to service old borrowing. At that point, money's role shifts. It stops being a neutral yardstick and becomes a release valve. History is remarkably consistent on this point. Every empire that accumulated excessive debt eventually chose inflation over default. Not because inflation is painless, but because it's quieter. It spreads the cost across the population instead of concentrating it in a single political moment. You can see the effect in everyday life. $100,000 in the year, $2,000 bought a certain lifestyle. That same $100,000 in 2024 buys dramatically less, more than 40% less in real purchasing power. The number looks familiar. The value is not. This is the rule change. Money is no longer designed to protect your purchasing power. It's designed to stabilize the system that issues it. And when you treat money as a safe haven in a system that uses it as a pressure release mechanism, you aren't being conservative. You're being exposed. For most of modern financial history, the hierarchy of risk felt obvious. Stocks were volatile but rewarding. Bonds were boring but safe. And as you got older, the responsible move was to shift out of equities and into fixed income. That logic became so embedded that it turned into default advice. Target date funds, retirement glide paths, and financial planning models were all built around it. And again, this rule wasn't foolish. It worked because the environment supported it. For nearly 40 years, inflation stayed low and predictable. Interest rates moved steadily downward. Governments were broadly trusted to honor their debt without needing to debase the currency. In that world, bonds did exactly what they were supposed to do. They preserved capital. They provided stability. They reduced volatility at the portfolio level. But those conditions no longer exist. The moment inflation rises above real interest rates, the math flips. Bondholders stop earning a return and start absorbing a loss. And when governments are carrying extreme debt loads, they don't just prefer low rates, they depend on them. That creates a structural conflict. The system needs buyers of government debt, but it also needs inflation to quietly reduce the real value of that debt. In that environment, bondholders become the shock absorbers. This isn't an opinion, it's arithmetic. Bond prices move inversely to interest rates. When rates rise, existing bonds fall in value. At the same time, inflation erodes purchasing power. So bonds in an inflationary high-debt system face a double hit. They lose market value as rates adjust upward, and they lose real value as inflation outpaces yield. You're exposed on both sides. That's why the past few years shocked so many investors. Between 2021 and 2023, broad bond funds, the very instruments designed to be defensive, lost between 15 and 25%. This wasn't a speculative corner of the market. These were core holdings in retirement portfolios, assets people were told would protect them when volatility arrived. They didn't fail because bonds suddenly became risky in isolation. They failed because the system they were designed to function in changed. In a high-debt economy, bonds no longer exist primarily to protect savers. They exist to fund governments. And when inflation is used as a policy tool, the cost of that funding doesn't disappear. It gets transferred quietly to the people holding the debt. That's the rule change most investors haven't fully absorbed yet. Bonds are no longer a safe haven in the traditional sense. They're a loan of trust to a system that needs your capital to keep functioning. And when that system is under pressure, preserving your purchasing power is no longer its top priority. What used to be the conservative choice has become a conditional one, and treating bonds as inherently safe without understanding the system they now operate in isn't caution, it's exposure. For decades, low interest rates felt like a permanent feature of the financial landscape. The United States could borrow cheaply because the dollar sat at the center of the global system. Treasuries weren't just debt, they were the world's primary reserve asset. As long as global trade, energy, and savings flowed through dollars, demand for U.S. government bonds stayed strong. Low rates weren't an anomaly, they were treated as normal. That assumption is now being challenged. The global system is slowly but visibly moving toward diversification. Not the collapse of the dollar, but a reduction in dependence on it. More trade is settled outside of USD. More reserves are held in alternatives. And as that happens, demand for US Treasuries becomes more conditional. Not gone, but no longer automatic. That distinction matters. When demand for government debt is guaranteed, interest rates can be managed as a policy choice. When demand becomes selective, rates turn into a price, and prices rise when buyers need incentives. This is the structural shift most investors underestimate. As global buyers become more sensitive to inflation, political risk, and currency debasement, the United States must offer higher yields to attract capital. In that environment, interest rates stop being a dial that central banks can freely turn. They become a signal, a reflection of confidence in the system issuing the debt. And once rates rise for structural reasons, the effects ripple outward. Higher interest rates compress equity valuations. Future earnings are discounted more aggressively, which lowers the present value of stocks, even if company performance doesn't change. The same logic applies to real estate. Higher rates raise borrowing costs, reduce affordability, and force prices downward. Consumer debt becomes more expensive. Mortgages, auto loans, and credit cards all absorb the pressure. This isn't speculation, it's math. A 1 to 2% increase in the discount rate can reduce the present value of long-duration assets by 20 to 30% or more. That's not a market crash driven by panic, that's a repricing driven by arithmetic. The entire financial system, stocks, real estate, private equity, was built on the assumption that capital would remain cheap indefinitely. When that assumption breaks, everything recalibrates. This is why focusing only on whether rates go up or down next misses the point. The more important question is why rates behave the way they do. In a world of rising debt and declining monetary dominance, higher rates aren't a temporary tightening cycle. They're compensation for risk. That's the rule change. Interest rates are no longer primarily a tool for stimulating or slowing the economy. They're a mirror reflecting how much trust the global system has in the currency, the institutions, and the debt behind them. And when that reflection changes, every asset priced off those rates changes with it. Most retirement strategies today rest on a small set of assumptions that feel almost unquestionable. Long-term returns will average around 7%. Inflation will stay contained at 2 to 3%. And the dollar you retire with will roughly buy the same basket of goods as the dollar you earn today. Those assumptions aren't random. They're embedded into 401k models, target date funds, pension forecasts, and nearly every retirement calculator people rely on. For decades, they worked well enough to become invisible, not debated, just accepted. The problem isn't that the math is wrong. The problem is that the measuring stick is no longer stable. Every retirement plan ultimately answers one question: how much future purchasing power will this pile of money give me? But when the unit you're measuring in the dollar loses reliability, the projections become misleading even if the formulas are internally correct. This is where many people get trapped. They look at their statements and see progress. The numbers grow, the charts slope upward. According to the model, everything is on track. But those numbers are denominated in a currency whose real value is being actively eroded by inflation and higher rates. The plan looks healthy on paper while quietly failing in real terms. Consider a simple example. David is 42 years old. He has about $350,000 in his 401k invested in a standard target date fund. He earns a little over $100,000 a year and contributes consistently. According to most retirement calculators, he's on pace to retire around 65 with roughly $1.8 million. That sounds reassuring, but that projection assumes inflation stays low, interest rates stabilize, and the dollar retains its purchasing power over the next 2 decades. If inflation averages 5% instead of 2.5%, a level well within historical norms during debt-heavy periods, that $1.8 million buys less than $1 million worth of today's goods. Nothing crashed, nothing failed visibly, the number still grew, but the lifestyle disappeared. That's the danger most people don't see coming. Traditional retirement plans aren't fragile because markets might drop. They're fragile because they're optimized for a system where money itself was stable. When that stability breaks, the plans don't adjust. They keep producing precise answers to the wrong question. The most dangerous moment isn't when portfolios fall sharply. It's when people feel safe because the numbers look good and only realize too late that those numbers no longer represent the future they were promised. This is the rule change. You're not poor because you invested poorly, and you're not behind because you lacked discipline. You're exposed because you trusted nominal figures in a system where real value is what actually matters. And when the measuring stick changes, every plan built on it needs to be re-examined, not emotionally but structurally. For most of the modern financial era, safety was defined in one simple way: accumulation. The more financial assets you owned, stocks, bonds, real estate, retirement accounts, the more secure you were assumed to be. Risk was framed as volatility, and safety was framed as size. That definition made sense in a stable system. When the rules were consistent, institutions were trusted, and money reliably held value over time. Accumulating financial assets reduced uncertainty. You could plan decades ahead because the framework underneath your plan stayed largely intact. But when the system itself starts to change, accumulation alone stops being protection. In periods of structural transition, the primary risk isn't market swings, it's rigidity. Systems don't punish people for being poor. They punish people for being inflexible when conditions shift. History shows this repeatedly. During every major economic transition, the end of the gold standard, post-war realignments, inflationary decades, technological disruptions. The people who survived best were not the ones with the largest balance sheets, but the ones who could adjust fastest. That's because assets are always denominated in a system. Skills are not. When currencies are pressured, markets reprice, or institutions rewrite the rules, financial assets absorb the shock. But the ability to generate value, to create, adapt, and reposition travels across systems. It doesn't depend on a single measuring stick. You can see this difference clearly in real life. Someone whose entire net worth exists inside traditional investment accounts is fully exposed to rule changes they can't influence. Their outcome depends on policies, rates, and assumptions made far away from them. By contrast, someone with transferable skills and adaptable business or income streams that operate across markets and currencies experiences those same changes very differently. They're not immune, but they're flexible. That flexibility is the new margin of safety. This doesn't mean financial assets no longer matter. They do, but they're no longer sufficient on their own. In a system where the rules are shifting, safety comes from understanding the environment, diversifying across frameworks, not just asset classes, and avoiding dependence on a single version of how the game is supposed to work. This is the final rule change. In a world where the system is stable, you optimize for efficiency. In a world where the system is changing, you optimize for resilience. The goal isn't to predict exactly how the future unfolds. It's to remain functional across multiple outcomes. Because when the rules are rewritten, the most valuable asset isn't what you own. It's how quickly you can adapt when what you own is no longer enough. When you step back and look at the full picture, one thing becomes clear. No natural laws have been broken. Gravity still works. Math still works. Cause and effect still work. What has changed isn't the universe, it's the system we agreed to operate inside. The danger isn't that markets fluctuate. Markets have always fluctuated. The danger isn't that recessions happen. Recessions have always happened. The real shift is quieter than that. The conventions that once made financial planning reliable, stable money, predictable inflation-safe bonds, permanently low interest rates, are no longer guaranteed. They haven't disappeared overnight, but they're no longer protected by the same conditions that made them dependable for decades. And that's what makes this moment uniquely risky. Most people don't lose because they made reckless decisions. They lose because they followed rules that used to work faithfully, patiently, and for a long time without realizing the environment those rules depended on had changed underneath them. When systems transition, failure rarely arrives as a dramatic collapse. It arrives as erosion, slowly rising costs, returns that look fine on paper but fall short in real life, plans that remain mathematically on track while quietly drifting away from the future they were meant to secure. That's why this isn't about predicting crashes or timing markets. It's about awareness. Because the most dangerous position isn't being early or being wrong, it's being unaware. The greatest risk isn't that the market falls. The greatest risk is spending your life optimizing for a game that no longer exists. If the rules change and you don't notice, you don't just lose money, you lose time. And time is the one asset that never compounds again once it's gone. So no, the system hasn't collapsed. But the rules have changed, and the cost of not noticing isn't panic. It's waking up one day with a number on a screen that doesn't buy the life you thought it would.